Hello, this is Sky Moore. This segment is called Tax and Equity. It's on the rules for calculating net profits for purposes of tax and for distributions to equity. There's 4 different categories where net profits comes up. There's accounting, generally accepted accounting principles. There's tax, which we're going to discuss now briefly. There is contractual, which we're going to discuss in another segment. And there is distributions to equity owners. So now we're going to talk about tax and equity. As I discussed in another segment, the rules for accounting, everybody's attempt is to make as much income as possible and report the highest net income they can, and I went through the various games of how to do that. For tax, the goal is the complete opposite. You want to report as little taxable income as possible and have the biggest deductions that you can. And remarkably, the rules are different for GAAP than they are for tax. Let's go back to my 10-year license for $1 million a year, and I discussed under GAAP that you're able to report the full amount of income in the first year when you enter into this contract based on the present value of the payments. And I gave an example of that you would report $7 million as the present value. For tax purposes, you don't have to do that. For tax purposes, you get to report $1 million per year as it comes in. And so it works in your favor. That is, you can effectively defer out the payments until you actually get the cash. Again, it's just one example of the differences between accounting and tax. Another good example is film income amortization. And I discussed that for the accounting rules, the goal is to deduct as little as possible of your film costs, and you do that by overestimating how much future income that you're going to get, because that drags out the deductions. For tax purposes, you want to report as much deductions as possible, and again, it's based on film income amortization. And remarkably, you don't have to do the same thing that you do for accounting. For tax purposes, you want to estimate as little future income as possible, because by doing that, you will maximize the deductions that you get to take in the first year. One big reason for doing that for tax purposes is that if you're not careful, you can end up with what's called phantom taxable income, and that results when you're getting cash in the early years that is 100% is being used to pay off a loan or other financiers, and what you can find is that you might have no cash, but you have taxable income because of this problem of income forecast amortization. That is, if you're only able to deduct part of your film cost in the early years, you will have taxable income with no cash to pay it because it's going to the lenders. So to solve that problem, many people are very aggressive on their income forecast allocation so that they try to match the deductions with the cash that they've got. The next category that I want to talk about now is distributions to equity owners. That is, dividends to shareholders, distributions to partners, distributions to members. The simplest way that you can think of distributions to equity owners is you just think that they get whatever's left at the bottom of the barrel. If you view distributions as a waterfall, you pay off everybody else first. Anyone who's you're owed money to contractually, loans, residuals, sales agent, and when you're done at the bottom, that's what's left to distribute, and you could think of that as net profits. And now you look at who gets those net profits. You read the governing agreements of the entity, whether it's the shareholders agreement or the operating agreement for an LLC, and they will often have levels of priority of payments. Sometimes there will be tax distributions. Maybe there's a preferred return to the capital investors, and maybe there's capital back. And then you'll get to how you split profits, which is what most people think of as at the net profit level. So they'll think of the others as items in the waterfall. And then the final confluence of factors to take into account on the equity side is the law. The law prohibits entities from making distributions that would cause them to become insolvent, which is basically the inability to pay off their debts. And so you can't distribute out an amount of money and leave your creditors high and dry. And those 3 factors go into how much net profits that you can distribute. So this is Sky Moore tuning out for this segment. Hope you join me for the next one.